Welcome back to the Market Podcast. Asymmetric info for individual investors. Educational info only, not financial or legal advice. Consult a pro before investing.
January 2021. You were watching GameStop shares just explode on your screen, heart probably pounding.
Oh, yeah.
You joined this retail revolution, right? Riding a massive wave against Wall Street.
It felt like that for so many people.
And then just like that, in an instant, the buy button disappeared. Locked out, couldn't sell, panic setting in as the market just whipsawed around you.
Yeah, that was intense.
That moment, for millions of individual investors, it wasn't just some technical glitch. It felt like a profound breach of trust.
Absolutely. It led to congressional hearings, lawsuits. It left a real scar. Still does for many.
But, okay, fast forward to now. This same company is making these, well, pretty bold strategic moves into blockchain. They're teasing tokenized stocks, incredible new crypto pokes.
Right. They're not standing still. Things like Robinhood Social, where you can actually copy top traders in real time.
Exactly. And seamless crypto transfers that, in theory, put you in direct control of your digital assets.
Key phrase, in theory. We'll get into that.
So the big question for you listening is, can these flashy new features, these innovations, truly rebuild that fragile bond? Or will the ghosts of GameStop just haunt them forever, keeping you skeptical, keeping you on the sidelines?
It's the multi-billion-dollar question, isn't it?
Stick around as we explore this company's empire, layer by layer, because by the end of this conversation, you'll have a much clearer picture. You'll know if it's time to, well, swipe right on their future or maybe run the other way. This could seriously redefine how you navigate the next bull run.
Let's dig in.
Okay, so let's begin right at the very top. With the individuals, the minds steering this ambitious company, understanding their leadership, their vision, their strategic choices is absolutely crucial for you, the individual investor.
Makes sense.
Because their decisions directly impact the opportunities and, frankly, the risks in your portfolio.
It's definitely the place to start. So at the helm, you have Vlad Tenev. He's the CEO and co-founder, a Stanford dropout, actually. His vision, the famous to democratize finance, that's really driven their aggressive pushes. First into retail trading, commission-free, and now, very significantly, into crypto.
He co-founded it back in 2013 with Baiju Bot, right?
That's right. And Tenev was key in steering that 2021 IPO, right in the middle of all the controversy. And more recently, he's the one spearheading this launch of tokenized assets on the blockchain, trying to blend traditional stocks with digital innovation.
His background's interesting too, isn't it? Quantitative trading.
Yeah, from firms like Citadel. And that background definitely informs their technology-first approach. You really see it reflected in things like their margin lending expansions. That actually boosted second quarter 2025 revenues by substantial 45%.
45%? Wow.
Yeah, it's significant. So this isn't just some figurehead. Tenev's fingerprints are all over the company's strategic direction. He's deeply involved.
Okay, so his influence is central. But who else is on this executive team? How do their roles kind of mesh together to shape the company's path and ultimately what that means for your experience as an investor?
Absolutely. It's definitely a team effort. You've got Jason Warnick, the chief financial officer. He's a finance veteran, came over from Credit Suisse.
Okay.
His role is critical. He optimizes all the various revenue streams, particularly the interest earned on uninvested cash. That particular stream surged significantly as interest rates climbed.
Right. That became a big profit center for many brokers.
Exactly. It provided a really stable backbone for their more volatile trading revenues. So think of him as the meticulous financial architect, making sure the numbers add up.
Got it. Who else?
Then there's Jeff Pinner. He's the chief technology officer, formerly at Uber, actually.
Ah, interesting. Tech background.
Very much so. He leads the entire tech infrastructure, which is absolutely vital for scaling what they're building now, the upcoming Robinhood Chain Layer 2 blockchain.
We'll definitely dive deeper into that Layer 2 later.
We will. It's specifically designed to handle tokenized real-world assets, but without the kind of volatility issues that really spooked users back in 2021. Pinner's job is ensuring the tech is not just cutting edge, but also resilient, reliable.
Makes sense. Operations.
That's Walter Collar, the chief operating officer. He has roots at Flexport. Collar manages the day-to-day operations. That includes these ambitious international expansions into Europe and Asia.
Which seems like a key part of their strategy now.
It is. It's a strategic effort to counter some of that past trust erosion, partly by broadening access and user engagement globally. Collar is all about ensuring smooth execution, from your trade right through to their global strategy.
And legal. That must be a huge job given their history.
Oh, absolutely. Lucas Moskovitz is the general counsel, formerly at Google. He's the one expertly navigating the really complex regulatory challenges, everything from the past Securities and Exchange Commission probes after GameStop to ensuring current blockchain compliance. His work is key so that new features, like those crypto transfers we mentioned, avoid any past restrictions or issues that could undermine user confidence again.
He's the guide through the regulatory maze.
Precisely.
Yeah.
Which is especially important for you, the investor, looking for stability and, compliance, making sure they're playing by the rules.
So we have these key leaders. And what's interesting, as you mentioned, is how deeply involved the founders still are. Vlad Tenev is still CEO. Baiju Pot is Chief Creative Officer. They hold significant combined ownership, over 7%.
Yeah, that's quite a stake.
Which means their fortunes are very much aligned with yours, the shareholders. But given the trust issues stemming from GameStop, doesn't their continued prominence also carry a significant risk? For you as an investor, does that deep founder alignment inspire confidence, or does it maybe raise some caution flags?
That's a really perceptive question.
Yeah.
And it is a critical balancing act. On one hand, you're right. This founder-led structure, it mirrors many successful disruptors, right? Where the original visionaries keep driving the innovation.
Like a tech company.
Exactly. And their incentives are tied directly to user growth, revenue metrics. Look at that 76% jump in Gold subscribers up to 3.5 million in Q2 2025. That shows a direct link between their strategy and boosting those recurring fees for shareholders.
And Tenev has been vocal about crypto regulation, too.
Very vocal. Even putting forth proposals to the Securities and Exchange Commission for tokenized assets. It demonstrates a commitment, at least publicly, to empowering retail investors over those traditional institutional gatekeepers. Their tech expertise certainly positions them to potentially outpace peers in blockchain adoption. They're aiming to foster trust through transparent tools like Robinhood Social's copy trading feature.
Okay, so that's the bull case for founder leadership.
Right. But your point about risk is absolutely valid. For many people, the GameStop incident is just inextricably linked to these founders.
Hard to separate.
Very hard. And while they've shown resilience, shown they can pivot, that past event means every single move they make now is scrutinized through that lens of trust.
So for you, the investor,
it means you have to carefully weigh their undeniable drive for innovation against those lingering questions about how they handle extreme market stress. Their mission to democratize finance for all, that's still their North Star. It's evolved from just commission-free trades to aspiring to be this comprehensive financial super app.
a big ambition.
Huge. The goal is to make Wall Street's multi-trillion-dollar corners, the ones often inaccessible to everyday folks, available 24/7. You see that in their European Union tokenized stock launch covering over 200 U.S. equities.
And the future vision is heavily blockchain-focused.
Absolutely centered on the Robinhood chain layer 2. Optimized specifically for real-world assets, promising sub-second trades without needing traditional broker intermediaries. So yeah, it's a story of a compelling vision, but also a profound ongoing need for them to continuously prove their commitment to you, the user.
That's a great way to put it. Let's pivot slightly and look at their past for a moment. To really understand the journey that brought us to this complex present. This company burst onto the scene in 2013 with a bold promise and its history. Well, it's been nothing short of a roller coaster, marked by incredible disruption and some really challenging moments.
It truly has been a ride. Founded by Tenev and Bart, they launched that mobile-first zero-commission app back in 2015, and it caught on fast. Amassed 1 million users by 2017. Partly through those gamified features, which were engaging, but later drew some scrutiny and got toned down a bit.
Right, the confetti.
Yeah, exactly. A major milestone was the 2021 IPO. Valued the company at an impressive $32 billion. Huge validation of their disruptive model at the time.
But 2021 also brought the low point.
The pivotal low.
Yeah.
The GameStop saga. Halting buy orders on those volatile meme stocks, driven by clearinghouse capital demands, sparked just widespread outrage.
Understatement.
Yeah. Led to multiple lawsuits, that big $70 million Fenner fine, and it significantly eroded trust. User growth stalled. It was a moment that profoundly tested the company's resilience, leaving a really deep scar on its relationship with individual investors like you.
Despite those incredibly challenging setbacks, the company didn't just, fold. It showed remarkable resilience. It pivoted. It expanded into entirely new areas. What did those pivots look like, and how have they contributed to the company we see today?
They certainly did pivot. They'd actually launched crypto trading back in 2018, though that initial push got halted by the Securities and Exchange Commission.
Ah, okay. Didn't know that.
Yeah, but they persisted. Expanded to over 15 coins by 2025. A really significant strategic move was acquiring Bitstamp in 2024 for $200 million.
That felt like a big crypto play.
It was huge, a direct effort to bolster their crypto custody capabilities and their global reach. And it ties directly into this broader strategy of rebuilding investor faith through self-custody options. For you, this means they're investing heavily in the infrastructure to give you more control over your digital assets, directly addressing those past concerns about platform control.
And the numbers started reflecting this rebound.
Oh yeah, the numbers tell a powerful story. First quarter 2025, revenues hit $927 million. That's up 50% year over year, largely driven by surging crypto activity.
50%.
And Q2 2025 continued that momentum, showed 45% growth to $989 million. Net income actually doubled to $386 million, coming from increasingly diversified revenue streams, not just trading anymore.
And market share.
Their market share in retail options trading climbed to over 20% in 2025. They're outpacing many peers there.
So the reinvention is really visible in the blockchain stuff.
Most evident there, yes. June 2025 saw the launch of tokenized stocks on Arbitrum and their own Robinhood Chain Layer 2. This directly addressed past criticisms about centralization by enabling 247 access to these assets, and it attracted 150,000 European Union users almost overnight.
Wow.
Now, it hasn't all been smooth sailing. There were failures like the 2022 crypto winter layoffs. They cut 23% of staff.
Right, that was rough.
But 2025's remarkable 99% platform asset growth, reaching $298 billion, clearly illustrates a strong rebound. This track record demonstrates the company's knack for turning disruptions into dominance. Though it's undeniable those trust scars from GameStop, they linger. A very real cautionary point for many investors.
So the core takeaway from their history seems to be this cycle. Disrupt, face a challenge, pivot aggressively towards new growth. What's one critical insight you'd offer to an investor looking at this trajectory?
I think the key insight here is that this company has proven itself incredibly adaptable, anti-fragile almost. They've repeatedly faced existential threats, regulatory pushback, major public trust crises, and each time they've not just survived, they've found new, aggressive avenues for growth. For you, the investor, this resilience, this ability to grow stronger from stress, it's a powerful signal. But it doesn't erase the need to scrutinize how they've rebuilt that strength and whether the foundations are truly solid this time.
Okay, let's get into the engine room. For individual investors, understanding how a company actually makes its money is paramount. It gives you insight into stability, future potential, and ultimately whether it's a good fit for your portfolio. Let's break down their business model.
Right. At its core, the model aims for simplicity and broad access. It's a one-stop app. Stocks, options, ETFs, crypto, all without direct commissions. Think of it like a digital vending machine for investments.
Easy access.
Exactly. You fund an account, trade freely. The company earns indirectly through, well, mainly two things. First, payment for order flow, or PFOF. That's where market makers pay them to execute your trades.
We need to talk more about PFOF.
Definitely. And second, earning interest on your uninvested cash. Much like a bank, but often at higher rates, especially if you subscribe to their gold tier.
Okay, what about the nuances? Crypto transfers, layer 2.
Good question. Crypto transfers, for instance, let you move assets like Bitcoin to your own external wallet. This involves network fees and verification processes designed to prevent hacks, obviously.
Self-custody, that's important for trust.
Crucial. Now, the upcoming Layer 2 blockchain adds another layer of complexity. Tokenized stocks imagine fractional Apple shares living on the blockchain, promise 24/7 trading, which is cool.
That's good.
But, and this is key, they come with centralized controls. Know your customer, anti-money laundering registries. It really mirrors traditional brokers in that sense.
So not fully decentralized.
Not at all. And this aspect could potentially confuse users expecting that full DeFi freedom. It's a key area for you to watch and understand the trade-offs.
Okay, let's go back to PFOF, payment for order flow. Market makers paying for access to my trades. For a company founded on democratizing finance, doesn't that kind of raise questions about transparency or even potential conflicts of interest for you, the individual investor? How do they ensure that's truly beneficial for the user?
That's a very fair and important question. It's an area that has historically drawn a lot of scrutiny. not just for them, but for the industry.
Right.
The company maintains that PFOF is what allows them to offer commission-free trading, making markets more accessible for you. They argue their routing systems are designed to get you the best available price, fulfilling their best execution duty.
But is it always the best price?
That's the debate. Critics argue there's an inherent conflict, but legally they have obligations. However, the centralized nature of Layer 2, even with its blockchain tech, with those traditional compliance checks, it shows they're walking a fine line. It's this ongoing tension between offering a user-friendly, low-cost platform and navigating the complexities and potential conflicts of market structure.
So for me, the investor,
It means understanding that free trading isn't truly free. There's an indirect cost. And you should always be aware of how your orders are being handled, even if the mechanics are hidden. Read the disclosures.
what really distinguishes this company then, beyond the free trades?
I think it's a unique blend. First, technology prowess. Their app user experience is generally considered best in class. Very intuitive.
Agreed. It's slick.
Second, a robust economic engine, diversified, high-margin revenues now. And third, despite the controversies, a persistent, stated passion for retail empowerment. They successfully disrupted legacy players like Schwab by just tearing down barriers to entry.
A super app idea.
Exactly. It functions as a true super app. You can actively trade stocks that saw 65% revenue growth in Q2 2025. You can earn that 5% APY on cash via gold. You can stake crypto for yield. And soon, tokenized private assets like shares in OpenAI potentially on Layer 2.
That private asset tokenization is interesting.
Very. Remember the meme stock frenzy? 13 million funded accounts spiked. The pivot after the halt towards crypto, now 16% of revenues, up 98% year over year, show their adaptability. Their EU tokenized launches 150,000 users almost instantly. It's blending traditional finance liquidity with blockchain speed.
So that trifecta, tech, economics, and mission.
Yeah. Cutting-edge tech with AI scans, a powerful economic engine reflected in that annual revenue per user of $151, up 34%, and that passion for financial democratization. That really sets it apart, despite the baggage.
Okay, so how do they actually reach you, the investor, and how stable is that income stream we talked about?
Their distribution model is primarily direct-to-consumer, almost entirely via that intuitive mobile app. Over 90% of users are mobile first.
No branches needed.
Exactly. Allows them to scale globally without that physical overhead. Big innovation. They offer 247 crypto access, expanding rapidly into the EU through strategic partnerships, like using Arbitrum for tokenized stocks.
And the blockchain integration for transfers.
That's unique, yeah. Facilitating seamless transfers for self-custody to external wallets like MetaMask. Early pilots showed this boosts engagement by as much as 20%. It's about empowering you to control your assets directly, a crucial trust-building step post-GameStop.
How scalable is the platform itself?
Impressively scalable, 13.5 million funded accounts now, $298 billion in assets under custody. That's up a remarkable 99% year over year.
Huge growth in assets.
Massive. And it's enhanced by AI-driven personalization. Custom indicators, things designed to improve user retention. Q2 net deposits at $6.4 billion, reflecting an 18% annualized growth rate. Driven by in-app nudges, referral bonuses, it's far outpacing competitors with those traditional branch-heavy models.
Okay, revenue predictability. How reliable is their income?
It's a blend. You've got variable trading activity that saw 65% growth in Q2, hitting $539 million from options and crypto, and then more recurring streams, which make up about 35% of total revenue.
So, moderately predictable.
I'd say moderate predictability is fair. Better than a pure brokerage model that relies solely on trading, but still definitely subject to market swings. More volatile than, say, a wealth manager with mostly fee-based income.
Where does the recurring revenue come from?
Mainly two places. Gold subscriptions, 3.5 million users paying $5 a month. That's over $200 million annualized. And net interest revenue, which is 34% of total income now, from holding $46 billion in customer cash.
So that Q2 revenue jump of 45% to $989 million shows stability through diversification.
It does. But those trading spikes still introduce volatility. For you, the investor, this means the company shows resilience during boom cycles, but it also highlights the need for your own diversified portfolio to buffer against potential busts in trading activity. Don't put all your eggs in one basket, as always.
That's a comprehensive look at how they make money. Now let's peek into their innovation pipeline. What new products and services are they rolling out, and how do these fit into their overall strategy to re-engage and, well, empower investors like you?
Their current lineup already shows a strong product-market fit for retail. The core app handles stocks, ETFs, which are about 29% of assets plus options, generating that 46% revenue growth, and crypto, offering 28 coins now with a 98% revenue increase. This whole suite serves 13.5 million users, yielding that 151 RL annual revenue per user.
And recent launches, the tokenized stocks in Europe.
Yeah, that was significant. June 2025, tokenized U.S. stocks and ETFs on Arbitrum for EU users.
Yeah.
Over 200 assets, offering 247 trading at a really competitive $0.03 per transaction. Attracted 150,000 users almost instantly.
Shows the demand is there.
Absolutely. Their crypto offerings also expanded perpetual futures, staking options, and crucially, that transfers feature allowing self-custody of Bitcoin and Ethereum to external wallets.
Yeah.
Verified via digital signatures. This directly addresses the trust issues from GameStop by removing some of that platform custody risk.
And the impact is visible in crypto revenues.
Really, crypto revenues hit $160 million in Q2. Significant growth.
Okay, tell me more about the future roadmap, this Robinhood chain layer 2. You mentioned it's like an express lane on Ethereum.
That's a good analogy. Think of Layer 2 as building a super fast express lane on the main Ethereum highway. It uses a specific tech called Arbitrum Orbit. Basically means it's designed for incredible speed, handling over 1,000 transactions per second.
Wow, compared to Ethereum's mainnet.
Much, much faster and cheaper. And your trades get finalized, settled within minutes, not potentially hours.
And it's for these real-world assets.
Exactly. This isn't just about speed. It's about making complex, real-world assets like, theoretically, tokenized shares of SpaceX or OpenAI tradable 24/7 without the congestion or high fees of the main Ethereum highway.
And how does Robinhood benefit directly from this chain?
Here's the smart part for them. They essentially become the toll booth operator for this express lane. They capture a share of the fees, specifically 10% of the sequencer profits, the fees generated from ordering transactions on the chain. That goes directly to their DAO, their decentralized autonomous organization, gives them more direct control and financial benefit.
So for me, the user, faster, cheaper, more diverse trading options.
That's the promise. Potentially faster, cheaper, and access to assets you couldn't easily trade before right on their platform.
What else came out of the Hood Summit? Robinhood Social.
Yeah. Hood Summit 2025 unveiled Robinhood Social. It's a platform for verified copy trading. See what verified successful traders are doing and mimic them. Plus AI indicators and scans and futures trading on their Legend platform.
Rolling out soon.
Set for Q4 this year. The idea is to foster a more collaborative investing environment. Maybe rebuild some community trust that way too.
Future plans beyond that. Asia.
Definitely. An Asia launch is planned for 2025, starting with Singapore as the regional HQ. Plus more staking options, perpetuals, more AI personalization. The overall vision is clearly that super app blurring traditional finance and DeFi, aiming to empower users and implicitly move past the restrictions that caused the GameStop outrage.
It sounds like an incredibly ambitious pipeline designed to really redefine their platform. Before we move on, what's one key takeaway for investors from this product roadmap?
I think the most important takeaway for you is that this company is aggressively building for a future where traditional assets meet blockchain tech. The focus on tokenized real-world assets and enabling self-custody through transfers are direct responses to market demand and, crucially, to past trust issues. They're positioning themselves at the cutting edge. But your awareness of the centralized nature of some of these solutions, even on Layer 2, remains critical. Understand the trade-offs.
We've talked about their ambitious products and how they reach you, the investor. But behind all these flashy features and impressive numbers, how does this complex machinery actually run? Where does the magic happen operationally, and how tightly integrated are their systems?
Their operational HQ is in Menlo Park, California, strategic tech hub. Right.
Yep.
Driving strategy and tech development, especially for that Layer 2 chain.
Makes sense. Silicon Valley roots.
Right. Beyond that, they have a substantial U.S. presence. Offices in Bellevue, Washington, that's engineering focused. Chicago handles operations and support, and New York is for finance and compliance.
And internationally.
They've expanded into 30 EU and EEA countries, plus the UK. And that significant upcoming move is the Asia debut in 2025, with Singapore as the regional hub.
So these different sites manage different functions?
Pretty much. Everything from trading execution, customer service, blockchain development. Now, they do outsource some non-core functions, like third-party clearing using Apex, for example, and cloud services via AWS for scalability. But, crucially, they strategically insourced key crypto custody functions after buying Bitstamp.
Why was that important?
Reduces their reliance on external pressures. Mitigates risks similar to those they faced during the GameStop situation with clearinghouses. It's a critical factor for building back trust, showing they have more control internally.
And vertical integration, how much do they control end to end?
I'd call it moderately integrated. They maintain direct control over the app's front end, the user experience. They control the order routing, leveraging their PFOF partners. And now, critically, they control the blockchain backend via the Robinhood chain layer 2.
Less reliance on Ethereum mainnet.
Exactly. Reduces reliance there for tokenized assets. Expected to cut transaction costs by a significant 90%. Owning Bitstamp further enhances their crypto supply integration, supporting those 20 coins, enabling seamless wallet and transfer functions.
What's the impact for the user?
Tangible impact. Faster executions, often sub-second. Significantly enhances user experience. Pilot program showed it lowered churn by 15%. Plus, these in-house solutions have apparently cut operational costs by 20% compared to outsourced routing. So for you, it means a more controlled, efficient, and potentially more secure experience within their ecosystem.
Okay, let's talk about competitive edge. Every investor wants to know what makes this company special. How does it protect its market position? What's its moat, that competitive advantage that you, the individual investor, should really pay attention to?
You've hit on a core question. They operate in a fiercely competitive retail brokerage market. Over $500 billion just in the U.S. Barriers to entry can be low technologically, but the stickiness of the user experience is a key differentiator.
And their market share.
Currently holding a respectable 20% in options trading, 15% in retail crypto. Their position is still that of a disruptor against incumbents like Schwab. Now, while they're protected somewhat by having 13.5 million users, their profitability can be vulnerable to dips in trading volume. Though that 65% transaction growth in Q2 2025 definitely helped shield their 39% margins.
So what are the key competitive advantages for me, the investor?
I'd highlight a few. First, economies of scale. This is a robust advantage. A larger user base significantly reduces their per-user costs. Remember that $151 annual revenue per user in Q2, up 34%. Fixed tax spending spread over $298 billion in assets, 99% growth there. Cloud efficiencies cut operational costs by 15%. Bitstamp integration lets them scale crypto without huge hiring sprees. And the Layer 2 chain amplifies this, enabling 247 trades for potentially just lower 3 cents per transaction, often beating competitors' premiums or complexities. For you, this translates directly to lower costs and broader access.
Okay, scale makes sense. What else?
Second, network effects. These are strong and growing. More users amplify value, especially through Robinhood Social that copy trading of verified trades. It fosters a community, maybe like Reddit, but within a regulated environment.
Does it drive growth?
Seems to. User growth was 10% in Q2, significantly driven by shared strategies, they claim. The whole meme stock era itself was a powerful, if chaotic, case study in network effects, added 3 million accounts through viral engagement. Now, Layer 2 tokens could create new value loops for real-world assets, value rising with adoption. We saw that with the 150,000 EU users joining quickly. These effects can lead to maybe 25% higher retention rates compared to non-social peers.
Yeah.
Means a more vibrant, engaged platform for you.
Makes sense. Tech and speed.
Third, yes, proprietary technology and speed. That Robinhood chain Layer 2 aiming for 1,105 transactions per second at low fees, designed to significantly outperform Ethereum's congestion for real-world assets. The user experience cleverly hides a lot of the blockchain complexity, making it potentially up to 5 times smoother than using typical DeFi wallets.
Easier transfers too.
Leads to better efficiency in transfers, yeah. Which are now fee-free after accounting for gas savings. This elite speed of execution, combined with rapid launches, social and futures in Q4, EU tokens launched in weeks, it discourages rivals. And it contributed to that 99% asset growth in Q2. For you, this means a platform that's not just fast, but constantly evolving with new, accessible tools.
Those are some compelling advantages. Scale, network, tech speed. It's clear this company isn't standing still. What's their actual strategy for the future? How much bigger can they realistically get, both for themselves and for you, the investor, looking at their potential?
Their growth strategy is definitely a hybrid approach. They're targeting penetration, market development, and product development all at once.
How so?
For penetration, they aim to grow those gold subscribers to 5 million, partly through attractive incentives like 2% deposit matches. For market development, they're expanding aggressively into Europe and now Asia with tokenized assets. And for product development, the focus is squarely on that Layer 2 chain, Robinhood Social, and further integrating AI.
What are the key drivers behind this growth push?
Several things. Expanding crypto offerings is huge. Analysts project a potential tripling of trading volume by 2026. International markets were another major driver. 30 EU countries operational, Asia expansion planned, and mergers and acquisitions like the Bitstamp purchase remain a tool for growth.
What's the potential upside, the opportunity?
It's substantial. New markets, like Asia's $5 trillion retail total addressable market, new products, private tokens, prediction markets maybe down the line. Further M&A of other exchanges isn't out of the question.
And the potential rewards?
Significant. Some projections show a 50% compound annual growth rate, or CAGR, aiming for $5 billion in revenue by 2027. International expansion alone could add maybe 20% more users.
What's the total market size they're playing in?
It's vast. Over $10 trillion in global retail investing, plus an additional $30 trillion, potentially, in real-world assets suitable for tokenization. Add a $2 trillion crypto market projected by 2030. They currently capture maybe 1% of this massive pie. The goal is to scale that to 5%, driven by Layer 2 initiatives and that impressive 18% deposit growth rate. For you, this paints a picture of a company with a very significant runway, actively pursuing diverse paths to increase its footprint and, hopefully, its value.
But every opportunity comes with risk. And a company with this kind of history certainly isn't immune. How robust are they against challenges, especially considering the past? What should you, the investor, be watching out for?
It's crucial to understand the risks, absolutely. On the supply chain side, they're digital native, no physical supply chain really, rely on AWS for cloud, partners like Arbitrum. That diversifies risk somewhat.
No vulnerabilities.
Definitely regulatory single points of failure. The Securities and Exchange Commission overseeing Layer 2 is a big one, but their multi-chain strategy using Ethereum and Arbitrum, plus building their own chain, helps mitigate some of that. Using Bitstamp as a backup for crypto ops also adds resilience.
Customer diversity.
Pretty broad now, 13.5 million users. About 80% still US, but a growing EU base. Diverse demographics too, 60% millennials, 30% Gen Z. This broad spread contributes to stability. You see it in the 99% asset growth, the low 15% churn rate, aided by new features.
You mentioned anti-fragility earlier. How does that play out?
Critically, yeah. The company has shown this ability to thrive, or at least adapt strongly amidst chaos. The 2021 trading halt directly led to that big pivot into crypto, now 16% of revenue. The 2022 crypto winter spurred the expansion of gold subscriptions, which then saw 76% growth. Stressors like market volatility seem to make them stronger, forcing adaptation through data insights. For you, this resilience is powerful, but it doesn't mean they're immune to future shocks.
What about long-term positioning? Longevity?
They seem well-positioned to capitalize on major secular trends. Digitization of finance, that huge $84 trillion wealth transfer to millennials is happening now. The rise of blockchain, $30 trillion in potential real-world assets. Mainstreaming of crypto. They aim to ride these waves by evolving the app into a super wallet via Layer 2, tokenizing everything, offering 247 access.
Okay, but what are the main risks to that growth story?
Several key ones. Saturation in the U.S. retail market. How many more users can they realistically add from that 13 million base? Intense competition. Fidelity's crypto push is real. Schwab isn't standing still. And regulatory hurdles, potential restrictions on Layer 2 functionalities could really crimp their style.
Known unknowns.
The Securities and Exchange Commission's final stance on tokenized private assets, huge question mark. And potential interest rate cuts that could significantly impact their interest revenue, which is currently 40% of income. A potential $300 million hit by 2026 if rates fall significantly.
And the scary ones, unknown unknowns.
Always possible. Geopolitical trade wars disrupting that planned Asia expansion, or a major black swan hack specifically targeting their Layer 2. That could severely erode trust all over again, bringing back all those GameStop-era trust issues in a flash.
That's a lot of incredible data, huge potential, significant headwinds. Before we move to financials, what's one piece of the story, the moat, the risks that you think an individual investor might easily overlook, but really shouldn't?
I think the single most overlooked factor is often the centralized nature of their Layer 2 blockchain. Everyone hears blockchain and thinks decentralized. But while it promises speed and efficiency for real-world assets, it still operates within a traditional regulatory framework, meaning control is not truly decentralized in the way many crypto purists would define it. For you, this means while you gain access to innovative products, you're still largely operating within the confines of a platform that, like in 2021, can make decisions that impact your access to markets. That distinction between their flavor of blockchain and pure DeFi is absolutely critical for your long-term understanding and risk assessment.
Okay, let's look at the numbers. They're telling a powerful story of turnaround and growth, as you said, but with volatility that definitely keeps you engaged. What's the current financial snapshot looking like?
You're right, the numbers aren't just growing, they're exploding,
Yeah.
signaling a major turnaround, but yeah, with that degree of volatility demanding attention. Second quarter 2025, revenues rocketed an impressive 45% year over year, hit $989 million.
Fueled by trading.
Primarily fueled by that frenzy in trading, yeah. Options alone hit $265 million, up 46%. Crypto trading soared to $160 million. That's a 98% increase. Equities saw a 65% growth.
So what's the key insight there?
It's not just the overall 45% jump, but where it's coming from. Options and crypto are leading the charge. The takeaway for you, the individual investor, is that while this shows incredible momentum, capturing current market enthusiasm, it also signals a business model still heavily reliant on speculative trading activity. This company is a powerful proxy for retail's risk appetite, right? But that very strength could become a vulnerability if or when the market turns.
What about profitability, margins?
Also telling, net income doubled to $386 million. That's a 39% margin, a huge jump from 18% previously.
How they manage that?
Significant efficiency gains, partly cost trimming through scale, but also that steady heartbeat provided by the 3.5 million Gold subscribers, generating reliable $5 per month recurring revenue amidst those big transaction spikes.
You mentioned the rule of 40 earlier. How do they stack up?
Yes, the rule of 40. Quick check. Revenue growth rate plus profit margin should ideally hit 40% or more for a healthy growth company. They're not just hitting 40, they're smashing it at an incredible 84.
84.
Yeah, 45% growth plus 39% margin. For you, the investor, this is a really strong signal of excellent product market fit. They've found something the market deeply wants, and they're delivering it profitably. Speaks volumes about operational strength.
Other efficiency metrics,
Yeah.
ROIC.
Return on invested capital shines at 25%, up from 10% in 2024. Shows efficient capital deployment, likely into that layer 2 investment paying off. Return on equity is an impressive 45%. Shows management's ability to turn shareholder equity into substantial profits.
And liquidity, debt.
Liquidity looks golden. Current ratio of 1.5, that's $8 billion in cash versus $5 billion in short-term liabilities. Debt to equity ratio is low, 0.4. Pretty prudent leverage post-IPO. And free cash flow doubled year over year to $920 million in Q2. Provides ample flexibility for that blockchain R&D.
Industry specifics, crypto value.
Crypto notional value on the platform reached $50 billion, up 200%. Gold annual revenue per user is over $200 now. And those tokenized volumes in the pilots already hit $1 billion. Screams they have an edge in retail crypto adoption.
Wow, those growth numbers are absolutely phenomenal, especially after the headwinds of a few years ago. I'm genuinely surprised by the sheer scale of this turnaround. But how do these numbers stack up against the competition? Are they truly outperforming peers like Schwab or Fidelity, or is this just market-wide tailwinds lifting all boats?
That's a critical question. And they are definitely outpacing key competitors right now. Their revenue growth of 45% significantly outstrips Schwab's 10% and Fidelity's 8% in recent comparable periods.
Margins, too.
Margins at 39%, top Schwab's 30%. In terms of efficiency, that return on invested capital of 25% edges out Fidelity's estimated 20%.
Yeah.
And their $8 billion cash pile dwarfs smaller competitors. So for you, this means they are demonstrating superior operational leverage and growth relative to the more established players right now.
What's the main weakness compared to them?
The primary weakness is still that more volatile revenue stream, especially when you stack it against Schwab's much more stable fee-based advisory income. So yes, they are growing faster, but you should be prepared for potentially bigger swings in their quarterly financials.
What's the overall financial trajectory been like?
Definitely upward, recovering strongly from that 2022 dip. Revenues dropped 12% during the crypto winter then, but rebounded with 37% growth in 2023, 40% in 2024, and now 45% in 2025. It indicates a sustainable path if Layer 2 delivers as hoped. Though, again, potential interest rate cuts could flatten 2026 growth by maybe 20% if that interest income takes a hit.
So fantastic numbers, strong growth, but some underlying volatility and REIT sensitivity to consider. What's happening right now that investors should be tracking? And maybe more importantly, what are other individual investors actually saying about this company online?
Okay, recent highlights. The 8 Hood Summit, September 9th and 10th, 2025, unveiled Robinhood Social, those AI tools, futures trading, that led to a 5% stock bump right after the announcement. Positive market reaction.
And earnings.
Q2 earnings, released July 30th, significantly beat expectations. $6.42 earnings per share versus 31 cents projected. Assets under custody grew to that $298 billion mark.
What's coming up?
Q3 earnings release in October. That'll be important to watch, especially for crypto volume trends. The Asia launch is planned for Q1 2026. Full Layer 2 migration set for Q4 this year. Externally, potential Fed rate cuts in September could boost trading activity. An ongoing SEC review of real-world assets is a key focus. Investors are watching closely for regulatory approvals for private tokens and trends in deposit flows. Positive news signals growth. Any resurfacing of trust-related probes would be concerning, given the history.
What about investor sentiment, the buzz online?
Yeah, particularly from individual investors on social media, Reddit, places like that.
Yeah.
It tends to be, frankly, negative to neutral overall. Rough estimate. Maybe 60% negative, 30% neutral, only 10% positive.
Still dominated by GameStop.
Heavily dominated by the scars of GameStop. And significant skepticism around Layer 2 centralization. Common concerns, you see. Layer 2 is just a walled garden, limiting true DeFi capabilities. Complaints about transfer delays, sometimes described as discriminatory security checks, and still strong warnings about past halts comments like, "Thieves, stay away."
Ouch.
Yeah. The priority for the company is clearly trust rebuilding, through social, through transfers. But caution prevails among many. They literally say, can't forget the GameStop fiasco.
Any positives in this sentiment?
There are. Excitement about the blockchain innovation itself. Some call it an aggressive traditional finance crypto play. Robinhood Social is seen by some bulls as a potential game changer. But the dominant narrative out there remains this clash. Innovation versus history. Can the future overcome the past?
Okay, let's talk valuation. At $121 per share, as of September 12th, up 3% after the summit buzz, market cap $104 billion. Trading at 25 times forward earnings. Is this premium justified by the growth? Or are investors potentially repeating past mistakes, getting caught up in hype? This is where valuation for you, the individual investor, becomes incredibly nuanced, right?
Valuation isn't just about plugging numbers into a formula, is it? It's a dynamic story. Potential versus pitfalls. Especially with a company like this, right in the middle of blockchain hype, but still carrying that baggage of lingering trust issues. At 121.25 times forward earnings, yeah, the question is whether that premium to peers like Schwab is truly justified by their growth trajectory.
Margin of safety feels crucial here.
Absolutely critical. That Ben Graham principle. Buying an asset significantly below its intrinsic value, maybe a 30–50% discount to buffer against errors or bad luck. For this company, where a GameStop-like shock could potentially cause a 20–30% drop even now, a robust margin of safety is paramount. At $121, you have to ask yourself, is there enough cushion if Layer 2 doesn't pan out as expected? Or if regulation bites?
People got burned in 2021.
Many did, overpaying near the 38 IPO price, or even higher. Today, valuation guides your decision on whether their big crypto and Layer 2 bet is a potential steal or maybe another trap waiting to spring.
How do you approach valuing at DCF?
Intrinsic valuation using discounted cash flow or DCF seems well suited given their evolving but now positive cash flows. If you project, say, $5 billion in revenue by 2027, that's a 30% CAGR, and assume they maintain healthy 35% margins using a 10% discount rate, you might get an intrinsic value around $150 per share.
Suggesting upside.
Suggesting maybe 25% upside from the current $121. That's one scenario.
What about relative valuation compared to peers?
Well, that 25 times price-to-earnings ratio is higher than Schwab's 20 times. But you could argue their 45% growth rate warrants that premium. Their enterprise value-to-EBITDA ratio of 18 times also beats Fidelity's estimated 15 times. So relatively, it looks expensive, but maybe justified by growth.
Let's steelman the bear case. Why might this be overvalued?
Okay, the bear thesis. Institutional investors worry about regulatory scrutiny. The SEC could potentially halt or restrict Layer 2 operations similar to past actions. That could cap their access to that $30 trillion real-world asset TAM at maybe just a 1% share, not the huge numbers they hope for.
Revenue volatility, weight cuts.
Bears point to revenue volatility. Remember the 12% drop in 2022. And potential interest rate cuts could erase a big chunk, maybe 40%, of that interest income, a potential $300 million hit by 2026. Retail sentiment on social media echoes these fears. House of cards, distrust, Layer 2 as a walled garden. Competition, especially Fidelity's crypto push, could erode their 20% market share. And at 25 times earnings, bears argue it's simply overvalued, especially if another crypto winter hits.
What does a bear case DCF look like?
If you run a bear case DCF, maybe projecting only 20% growth, margins compressing to 25%, using a higher 12% discount rate due to risk you could get a value around $80 per share. That implies a potential 34% downside.
Okay, now the bull thesis. Why might it be worth $121 or even more?
The bull thesis, which institutions are also considering, focuses on diversification and growth drivers. Crypto is now 16% of revenue, projected to triple by 2026. Layer 2 chain has the potential to unlock that massive $30 trillion real-world asset market. Even capturing 10% could yield $3 trillion in volume eventually. Asia expansion adds another $2 trillion TAM potential.
And the recent performance?
Bulls point to the strong Q2 performance, 45% growth, 99% asset accumulation as signs of powerful momentum. That 35% recurring revenue from gold provides a stabilizing base. And social media bulls highlight the aggressive infrastructure build-out, calling Robinhood Social a game changer.
Bull case DCF.
A bull case DCF, maybe using a 40% CAGR, assuming 40% margins hold, and a lower 8% discount rate, reflecting optimism, could yield a valuation around $200 per share. That suggests a significant 65% upside.
So where do you land? Most probable scenario.
Considering all these factors, the bull case seems more probable right now, given the strong growth drivers in crypto and Layer 2 within the current 2025 bull market environment. The company has demonstrated resilience, that anti-fragility, especially in its rebound post-2021. However, at $121, there's no deep discount here. You might find a 10-15% margin of safety, perhaps, if Q3 earnings beat expectations again. Definitely something to watch very closely. It's priced for strong execution.
We began this conversation reflecting on that GameStop halt, a moment that really shattered trust for so many investors. Now, after exploring everything, the leadership vision, the innovative Layer 2, Robinhood Social, crypto transfers, can this company truly rebuild that fragile bond with you, the everyday investor?
I think the truth is hybrid. It's nuanced. New tools like Robinhood Social and the enhanced transfers feature, they represent a genuine strategic pivot towards user sovereignty, towards giving you more control and transparency.
Do they have the potential to rebuild trust?
Incrementally, yes. Robinhood Social, with its verified sharing, democratizes market insights. Follow proven strategies, not just anonymous tips. And self-custody options through transfers directly echo that fundamental crypto principle: control your own assets. Not your keys, not your coins, right? These moves can re-engage even skeptics, especially if they are executed flawlessly without hiccups.
But there's a however.
There's a however. The centralized core of their Layer 2 blockchain means that the ghosts of GameStop, the underlying fear of future restrictions in times of extreme market stress, will likely persist without a more radical, perhaps unlikely, move towards true decentralization.
So still a walled garden to some extent.
In a way, yes. While they're pushing innovation hard, that centralized control, with its KYC-SAML registries, feels like a necessary regulatory compromise, but also a significant limitation for those expecting pure DeFi freedom. So it's a definite step forward on trust and features, but maybe not the full leap into the truly permissionless future some users envision or desire.
So wrapping this up, what does this all mean for you as an individual investor trying to make sense of it all? One thing to watch. Those third-quarter deposit flows after the transfers feature has been live for a bit. If net deposits exceed, say, $7 billion, that's a strong signal that trust is rebuilding, that users are re-engaging positively.
Good metric to track.
But also, maybe consider this. While platforms like this evolve, offering increasingly sophisticated features within their ecosystems, the truly permissionless path of decentralized assets holding your own keys offers the ultimate hedge against platform risk. It empowers you beyond any single app's whims or potential restrictions, giving you unyielding control over your own financial destiny. What if the most powerful investment you make isn't just in a platform, but in understanding the fundamental difference between a centralized platform's promises, however innovative, and the absolute control that comes with holding your own keys?
A profound thought. Where does true financial sovereignty lie?
It's definitely a thought worth exploring as you navigate your financial future in this rapidly changing landscape.
Love this? Drop a like, subscribe, and ring the bell so you never miss a podcast.